Hi, if you want to know the 5 ways that real estate pays you a return on your investment, stay tuned. Hi, Alex Craig here. Welcome back to Turnkey 101. Last time we talked about the turnkey model of how buying turnkey, spend a little more up front, but you're saving money on the back end. Anything you do, success is set on the front end, and that's what turnkey did or does. Today we're going to talk about the 5 ways that real estate pays a return on investment. And this is why I love real estate. If you go to your Charles Schwab broker and you give them money to go take it into the market, you've got one way to make a return. It's what you buy those securities at and what you sell it. The spread on that is what you make. But real estate's different. There's 5 different ways that you can make a return. Let's go through those. All right, number 1 is appreciation. So on a normal market, 3 to 5% is what your property should appreciate. Now the last couple, 2-3 years, there's been a wild run up in appreciation, but a normal market rate is about 3 to 5%. So if your property, you bought it for 100 and it's worth 105 the following year, your property is worth more, obviously. That's a return. You don't see it, you don't feel it, but one day when you exit that investment strategy, we've had a lot of clients over the past few years that held onto the properties for 8 or 9 years, turn around and they started to realize the return on the appreciation. Here's the one that everybody focuses in on, and I get it. This is the one that, hey, it's money out of your pocket and it's money coming back in. It's the cash flow. That's why a lot of people are in real estate, and I'd say that's why most people are in real estate, and that's what you're feeling each month. So, we say if you could get 7 to 10% return, that's good cash flow. That's the money you're getting in from rents minus your expenses. So anyways, that's what everybody focuses in on. But when you start looking at all these others, that 7% can easily turn into 15 to 25%, and that's what we're going through today. The loan pay down, I love this one too. This is your resident every month paying a house you don't live in. So every month on your 30-year mortgage that your resident pays the rent, your mortgage goes down. That's equity you have in the home, and that is an additional return. So, your first year, let's say you're out of pocket $30,000 and your mortgage through your mortgage payment went down $800. So you figure in, what is that $800? You don't feel it, but it's there. And it's like, with the appreciation, when you go to sell your property, you feel number 1, you feel number 3, but 2 is the ongoing one you feel every month. This is my absolute favorite, the tax benefit. This is, I'm in the real estate for, 1, 2, and 3, of course, but the tax benefit's great. We do our taxes late every single year. We just filed, it's September 15th. We take our money and use it to operate within our business, buy and flip houses, and use as much capital as we possibly can. I think the IRS charges us 7% interest, which is cheaper than what banks will give us right now. So we file our tax return late. And nothing wrong with that. We just pay a little bit more, but we feel that we get the benefit of using our money year round. But this is why, as a full-time real estate investor, I love it. You won't be able to zoom in on this. We'll flash it up on the video, but we through this one portfolio in Little Rock, we had a total expenses of $368,000. And when you look in here, you see you've got on the other side, you've got your rents, and then we've got $638 in repairs, but then here's $7,103 in depreciation. That's an expense. It's not an expense that comes out of my pocket. But on the bottom line of this property, even though we made money, our tax return says we lost $4,134. This portfolio in Little Rock for us, we lost on paper $299,720. That's money that, on our tax return, if my tax return said I made $299,720, that's what I made. And then you have this depreciation amount, that's zero income, and that's how you start reducing your tax burden. So if you're a full-time real estate investor, you are keeping more of what you make. And that's something to talk to your CPA about. If you're, you got a spouse and they're working a part-time job, figure out how to make them a full-time real estate investor. The tax benefits are huge. If not even a full-time real estate investor, you can write off the mortgage deduction. Your CPA will take that. If you buy real estate education courses, those are tax deductible. And let's just say, hey, you bought some properties in Memphis or Little Rock. You want to go check it out. You want to get away for the weekend and spend it in Memphis. That's a business expense. You've got a business in these markets that you can come travel to. Definitely, I'm not a CPA, but a good CPA will capture certain business expenses. Your cell phone, you can write off a portion of that. You've got a home office now. But anyways, consult with your CPA, but the tax benefits are great. We wrote 3 to 5% on this one, recapping. About 4% is what you'll return on your loan pay down. But the tax benefits, for me, it's way higher than 3 to 5%, but on average, that's about what can add to your return on investment every single year. And then the hedge against inflation. This one's hard to measure, but if you're buying something today with today's dollars, those dollars are worth less money and you're receiving rent every single month. So you're buying something today that's going up where your money's going to be worth less. A lot more complicated. It's really hard to quantify that, but the hedge against inflation is one of the ways that real estate returns. So anyways, we add up on the low end, you're making 3% a year on your appreciation added to your return. You make 7% cash flow. Your loan pay down is 14%. Your tax benefits 3%, 17%. Let's just throw in 2% here. That's a 19% return. Of course, you're only feeling this one right here, but the other returns are there. When you sell your investment or you're taking number 4, your tax benefit, you'll definitely feel the return there because you'll keep more of your money. But that's the way, that's why people are in real estate. That's why it's a great tool for the average investor to go out and build a portfolio of homes, 5, 10 homes. If you've got a spouse, and you could get up to 20 single family loans or multifamily to 4 units. So anyways, that's why I love it. Not to keep beating the dead horse, but hey, I've got stuff in a swap account. That's why I mentioned that at first. And it goes up and goes down, but whatever, there's no other benefits. It's just what I bought in at, when I sold it, and one day when I cash out, I hope it's higher. But real estate, every year you're getting blended returns. Even if this number 2, you had a bad year, you had to put a roof on it, and this, maybe you lost money on the cash flow. You're still making money on these other things. May not feel it, but it's there. Anyways, Alex Gray here, talking about the 5 ways. I appreciate y'all tuning in, and we'll catch you next time.